Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, we'll be joined shortly by our featured guest co-host, Peter Hodson, Chief Investment Officer at I2I Capital Management. And later, we'll sit down with our featured guest, the co-founder of Transcripts, who was named in Forbes 30 Under 30 this year. And we want to hear from you this morning on First Call. You can reach us with your questions on North American small and mid-cap stocks, and we'll have Peter Hodson answer as many of the questions as he can. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And, of course, you can also email us, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you here in the BNN Bloomberg newsroom. Baytex Energy has unveiled its targets for 2026. The company plans to spend as much as $625 million in exploration and development, which is expected to generate production growth of 3 to 5%. Baytex says first quarter production is also expected to average up to 69,000 barrels of oil a day and ramp up to 70,000 by the end of the year. The company has also appointed a new president and chief operating officer. Shares of NVIDIA are edging higher in pre-market trading. According to Reuters, the chip giant plans to ship its H200 chip to China by mid-February. The report says NVIDIA expects to ship up to 80,000 of them and also plans to add new production capacity, with orders for that capacity opening in the second quarter of next year. Beijing has yet to approve any purchases, and the timeline could shift. And now our top line story, the price of gold and silver, both of them in record territory. Gold trading above $4,400 an ounce for the first time. All this comes as geopolitical tensions rise and bets that the Fed will continue to cut interest rates further for next year. And then you can take a look at silver, which is having an even better year. Now, for more, let's bring in our guest co-host, Peter Hodson, Chief Investment Officer at I2I Capital Management. Peter, thanks as always for joining us.
Thank you very much, Roger.
Is this a trend or is this a little spurt where this is something you think could continue, right?
Yeah, I mean, it's been an absolute party in the sector this year, and there's a number of things going on. Obviously, there is some geopolitical tension, but of course, there kind of always is in the world going on, in depending on where you look. But it's really a combination of currency debasement. You've got lower interest rates, and you've got supply issues. We've heard stories of silver shortages, and silver now actually has a use in data centers and connectivity and cooling. And so when you get a combination of those factors, investors are really, really looking at the precious metal market right now. The other thing that's happening, of course, is it's a relatively small market. The gold market and the silver market, it's the physical gold market and the physical silver market are not huge. And so when you get any sort of capital flows going on, it can sort of overwhelm the supply-demand picture, and prices go up, and people have to pay more just to get that access to supply. And so I really do think it continues. We're kind of breaking out here technically, and you've got all the conditions are in place for a continued rally. I wouldn't expect the same kind of returns in 26 as we did in 25, but certainly conditions are good for momentum to continue for a bit longer for sure.
Now, I want to ask about a lot of banks are buying, except Canada, which sold off all of its gold. Talk to me a little bit about that.
I don't want to get political, but every other central bank is every other central bank is buying. It does help, to have currency reserves or protects your currency reserves. And obviously, other countries are saying, you know what, this is a way to protect from currency debasement from other countries, in our trades and in our deficits and things like that. And I just sort of shake my head. It's like, from a diversification point of view, gold adds diversification to all of your reserves, whatever they may be. And to go to 0% just almost makes no sense in any asset category, as far as I'm concerned.
And so what do we do? What do you do? I want to talk about silver too, but let's finish with gold here. What do you do with that heading into 2026? Is it too late to get in, or is there still an opportunity there?
Yeah, I mean, you don't want to be a FOMO investor, but it's a situation where we believe that gold is a pretty good asset class. It's held up for 5,000 years in terms of protecting the value of currency, and it's a store of value. A lot of people thought that cryptos would take that place, but it really hasn't. Crypto is just completely volatile and not like gold at all. So I think that it's a question of, don't say, okay, well, I missed the party, I'm not going to go there. Just say, okay, it's a regular asset class. It has done well. It protects against currency debasement. And maybe I should own 5 to 10% of gold or gold stocks. You don't have to go crazy. You don't have to be a gold bug and go 100% gold or anything like that. But the real question is, do you think our currency and other currencies are going to be worth more or less in 10 years with the way that deficits and budgets are going? And if you answer that question, I mean, everybody's going to say, no, they're going to be worth less. And that leads to perhaps gold being worth more over that time frame.
Okay, and then silver's the other one. It's actually outperformed gold. Different reasons, though.
Yeah, this is really a physical shortage. There's a lot of chatter over the past decade, really, about how some of the ETFs have lent out their gold, and it's, when they try and get it back, it takes longer to get there. The physical production is not as strong as gold, but it also is an industrial use. It's a great connector. It's a great conductivity metal. And it's now getting lots of usage in AI data centers with cooling applications, connectivity applications. And this has kind of come out of nowhere. Silver is kind of, over the past 18 months or so, it's like, you know what? It's now an AI stock, or it's an AI metal. And of course, everything AI has gone a little crazy. And so you get that kind of extra boost in addition to all the other things that are helping out gold. So I think silver probably outperforms in the short term. The big question, of course, will be what happens when there's a crisis in the market or there's a crisis in the economy, because that industrial usage for silver will hurt it when people get scared of the economy or they get into worries about a recession. Whenever things are bad, gold does better than silver, but right now things are pretty okay, so no one's too worried about that.
Okay, we're going to take a break on that note there, Peter. Stick around, though. After we'll take a look at the markets. Then, of course, Peter Hodson will tell us what it will take for small caps to actually do better. Stay with us here. See how things are shaping up on the markets. We'll start with U.S. futures, and starting to look like we could see a Santa Claus rally after all. You can see all of them are up. The Dow up barely, almost a wash really, but the Nasdaq it's up 0.65%, and the S&P 500 right now is up 0.42 at this point. Over in Asia, how did they end up the day? They ended up on the day. Semiconductor and AI names driving the Nikkei. It was up 1.81%. Chinese blue chips gaining as well. You can see the Hang Seng. CSI 300 also up. CSI 300 up 0.91%. Hang Seng up by 0.43. Heading over to Europe. Bit of a cautious day, a little bit of a down day in spots. There were some record highs set last week, but the FTSE's off by 0.4%. CAC 40 down by 0.36, and the DAX is a wash right now. TSX, it finished the day on Friday at a record high, capping a second straight week of advances. It's up about 1.4% at that time. Let's see who was moving it, maybe who was dragging it down a little bit as well. Bitfarms up by 11.86%, Celestica 9.21%. On the downside, Curaleaf continues that roller coaster, 6.12%. BlackBerry off by 14% after reporting its earnings last week. And of course, metals. Everybody's talking about it right now. You can see gold into record territory, surging again, up 1.65%. At more than $4,400 US. Silver, though, as well, no slouch. It's up 2.5% and at 69.20 right now. And copper also hovering around record territory. Expectations of further rate cuts, geopolitical tensions fueling all that. And taking a look at fuel and oils, you can see a similar situation. It's Western Canadian Select up 0.91% on Friday. And south of the border, what's WTI doing right now? Look at that. It's jumped to 2.25% and closing in on 58 after trading near 5-year lows in the last couple of weeks. Well, small caps underperform large cap stocks again in 2025. And we're back with Peter Hodson of I2I Capital Management to tell us what it will take for the small caps to actually do better in 2026, Peter, it sounds like people have to find them.
Well, yeah, you have to sort of get noticed to get anybody to buy your stock. And of course, nobody makes any money unless somebody else buys your stock as well. It's been a pretty sad experience in the small cap land. From some accounts, small caps have underperformed the large caps for the past 14 years. So this year we got a little bit closer. We had the Russell 2000 was up about 13% and the S&P 500 up 16%. So, it's good, but it's not as good as it should be. And here's really the crux of the situation. Small companies have much greater leverage to single deals, single acquisitions, single contracts, and things like that. And as a group, they tend to grow much, much faster than large caps. Obviously, if you're a $4 trillion company, it's pretty hard to double to be an $8 trillion company. But if you're a $200 million company and you get a big contract, lo and behold, you can be a $500 million company pretty quickly. So small caps have grown historically much faster. And because of that, they've been much more expensive on average when you look at sort of all the valuation metrics that people look at. But right now, you can get that faster growth at actually the same PE ratio as large caps. If you look at other metrics like price sales, price book, small caps are actually much, much cheaper than large caps. So faster growth at lower valuations tends to be a good investment strategy over time, but you just have to get investors saying, okay, we're confident enough to go down that market cap scale. We want to not worry about the liquidity. We have to make sure that everything's okay with the overall market before we buy a small cap company. And I think the conditions are right, but honestly, Roger, I would have said that 6 months ago and a year ago and probably 2 years ago as well. So one of these days, small caps will shine, and you might get a 30-40% year one day. But it really has to get all those conditions in place, and confidence is a big one. As long as the overall market's okay, I think small caps can rock and roll. But if the overall market cracks, or if we go into correction, then no one wants to have a riskier company and go down the small cap market capitalization scale. So you do need that backdrop, but lower interest rates will help. The onshoring of North America, everybody's moving back to North America, will help the North American companies, obviously. A lot of companies do not have any debt because the banks don't want to give small companies a lot of debt. And so conditions are right. And sometimes it's just a waiting game, and you might get an overnight success story that took 14 years in the making.
Now, are there sectors within the Russell that are performing better or offer better opportunities?
I mean, in terms of Russell, so there's still some tech small caps that are doing well, and industrials are doing well because of that onshoring impact, and there's a lot of infrastructure spending going on. But across the board, healthcare is not really very exciting. Some of the other sectors really haven't done a whole lot. So you haven't had that broad-based rally where everybody sort of shifts from large cap to small cap. So I think actually all of the sectors could do well if we kind of get that rally that occurs. But as I was saying, it's not guaranteed. And of course, nothing's guaranteed in the market. The one thing that is a little bit more assured is a small cap January bounce. There's no sure thing in the market, but the January small cap bounce is probably the closest you're going to get to a sure thing. People sell off their losers in the end of the year, and they have no liquidity. So if someone's selling for tax purposes, they don't really care about the price. It's like, get me out of that stock. I'll take the tax loss. And that sets up a pretty good bounce in January. Historically, it's been very, very positive and far above sort of what you might expect from statistical, averages. Again, every year is different, but that's one of the things that you can sort of rely on more than other things.
What are you looking for with those stocks that are maybe being sold off and looking for the bounce? What are some of the things you might be looking for in those?
So you're looking for earnings, you're looking for consistency. It'll be too early in January to get the year-end earnings, of course, but it's more of a situation where it's actually more of a situation of what you're looking for right now. What you're looking for are volume spikes and what we would call the puke out trade, where an investor just says, forget it. I'm just going to sell 500,000 shares of this illiquid stock, and I'm going to drive down the price because I don't care. So take a look at volume. Some of the technical indicators like RSI can be helpful, but it's really volume, and you want to see a shift in momentum going into the last couple of trading days of the year and into the first week of January. If you can get a shift in momentum and then volume picks up again on the momentum side, on the positive side, then that can be a good indicator. The other thing, again, it's hard to time this, but January is not a bad time for this in general, is a lot of M&A activity. You've got rates going down, you've got large caps at a premium valuation, and so it's very easy for a large cap company to say, I'm growing at 14%, but if I buy this other company, I can grow faster because they're growing faster at 14%, faster than 14%. So you could see some M&A. We've seen quite a lot in Canada over the past year because Canadian small caps have been, quite frankly, worse than the US small caps. So if you get a combination of earnings, growth, lower interest rates, and M&A activity, then I think investors will finally say, hey, it's time for a small cap party this year.
Okay, we're going to wrap it up there, Peter, but we're coming back with you and your market predictions for 2026. As we get ready to close the books on 2025, investors are asking what themes will shape markets in the year ahead. We're back now with Peter Hodson of Eye Capital Management to get his predictions for the new year and get out your crystal ball. And Peter, let me know what you're seeing. Let's talk stock market in general first.
So I think we're going to have another good year. As we were talking about, conditions are pretty good. You've got corporate earnings as a group expected to rise 14.1% next year. And markets they respond to corporate earnings and they respond to interest rates. So you've got higher corporate earnings and lower interest rates ahead. As long as inflation stays, not a problem, if you can stay at 2.7% or 2.8%, then investors will focus in on the corporate earnings growth, and I think we'll be okay. A lot of people will say, oh, you know what, we've been really strong for 3 years. There's no way the market can go up. But coming out of 2009, we went up 9 years in a row. And there have been decades before when you've gone up 9 years in a row. I'm not going to predict that. And I'm going to predict that 2026 will not be as good as 25, but I think we'll still be net positive for both markets next year.
How much of a factor will 2025 be on next year? Because it was kind of an abnormal year in many ways, was it not, with what we saw in April and the quick rebound to it, the quick recovery to it?
It's a situation where right now I think investors have been trained and rewarded to buy the dips. Ever since COVID came along, people said, you know what, every time the market goes down, I'm going to buy some and I'm going to make lots of money. And you've got all this retail investors through Wealthsimple in Canada and Robinhood in the US that have been absolutely trained to buy all the dips. So I think 25 will be a positive influence on 26, A, because it's, we've had a pretty good year, but B, that reinforcement of buying when things are down, paid off yet again. And even in the little December dip that we had a couple of weeks ago, we're now back in positive territory for December for most markets. And once again, investors are like, every time it's down, I should buy. And until that mantra changes, I think we'll be all right.
Okay, and we talked about gold off the top, a little bit more about gold. And also you mentioned, you think a 1% interest or a race to it at least in the U.S.?
Well, this is where it gets interesting because, of course, Mr. Trump wants interest rates as low as possible. And he's sort of influencing the Fed decisions and trying to stock the Fed with his cronies. And none of this will be good for the U.S. dollar. It may be good for the economy. It may be good for trade. But in terms of the U.S. dollar, it's not going to be good at all. And gold responds to the U.S. dollar in a couple of ways. One, gold is priced in the U.S. dollars. And also all the other currencies, like all the other international buyers, if the U.S. dollar gets cheaper, gold becomes far more attractive to them as purchasers. So I don't know. I'm smart enough not to predict where interest rates are going to go at the end of the year in terms of what could happen with the Fed. But as we were talking about earlier, the easier prediction is that the U.S. dollar is not going to be super strong this year because of what's happening with the deficits, with spending, with interest rates, and with the Fed. So that makes gold an easier call than some of the other calls.
And if that dollar weakens, Canadian dollar likely strengthens, but then the interest rates in the U.S. drop, maybe even get lower than here. What does all that mean for Canada and our stock market and our economy?
I mean, it's a really, really tricky trying to gauge the influences of both markets. So on the one hand, we do follow the U.S. and they're still a big trading partner despite the tariff situation. But on the other hand, the U.S. still is stronger than us in most regards. Our recent employment numbers have been pretty strong and kind of surprising. So the Canadian dollar has done well this year. But I think overall, the U.S. is still in a better situation to sort of improve their economy and grow from here. I don't think our corporate earnings are going to be in the 14% range. One of the big problems with Canada, of course, is our mining and banking influence on the sector and on the stock markets. If gold goes up and financials go up, then we're going to have a great year. But if gold does sort of hiccup and go down a little bit, it's going to be very hard for the Canadian market to perform. And certainly if the financial and the bank stocks don't do well, then it's almost impossible for the Canadian market to outperform. The US is just more diversified. They've got a greater influence of technology, with the S&Ps at 32% technology, and we're far, far below that in Canada. So I think Canada will be okay, but economically, I think the US will win, and that leads to maybe a little bit of a dip in the Canadian dollar, but I wouldn't expect too much there.
Okay, and a couple of stocks to watch. You think Alphabet's going to catch NVIDIA?
I really do, and it's not a knock on NVIDIA at all. I do think the AI trade is going to be good for 12 to 18 months more, and the demand's there, and all the big companies decided to spend more on CapEx in their last quarter. They announced more spending, but it's really just diversification. Alphabet's got so many pieces of the growth pie ahead of it. It's got part of SpaceX, it's got Waymo, it's got the cloud, it's got YouTube, it's got search. It's now the absolute leader in AI with Gemini 3. And so it has all the influences that NVIDIA does, but if things go the other way and there's some sort of problem or spending or correction in AI, it should hold up better. I think right now, I didn't check it this morning, but I think there's about a 400 billion market cap gap between NVIDIA and Alphabet. Apple's in there somewhere as well, but I wouldn't expect Apple to outperform those two this year in 26. And so one of my calls is next year, Alphabet's going to be the biggest company.
Okay, we'll leave it on that note there, and we'll hold you to it, and we'll talk in a year. All right, up next, a Toronto-based tech startup recently secured a $20 million seed round to develop its data securities network. We'll talk to its founder after the break. And our phone lines will soon be open for our first call segment. And you can reach us at 1-855-326-6266. Send us an email as well if you want. First call, bellmedia.ca. Canadian-based explorer and developer Altius Minerals is acquiring Lithium Royalty. The deal is worth $520 million and will give Altius ownership of 37 new royalties, with the vast majority of assets located in Canada, Australia, and South America. Altius says the acquisition will also create a significant pipeline to the battery metals component of its business. Baytex Energy has unveiled its targets for 2026. The company plans to spend as much as $625 million in exploration and development, which is expected to generate production growth of 3 to 5%. Baytex says first quarter production is also expected to average up to 69,000 barrels of oil a day and ramp up to 70,000 by the end of next year. The company has also appointed a new president and chief operating officer. Shares of NVIDIA are edging higher in pre-market trading. According to Reuters, the chip giant plans to ship its H200 chip to China by mid-February. The report says NVIDIA expects to ship up to 80,000 of them and also plans to add new production capacity, with orders for that opening in the second quarter of next year. Beijing is yet to approve any purchases, and the timeline, of course, could shift. And taking a look at U.S. futures right now, it's shaping up. We could see a Santa Claus rally coming up. And right now, everything is in the green, being led by the NASDAQ. It's up by 0.6 in pre-market. S&P 500 by 0.45. Transcripts recently secured a $20 million seed round backed by leading venture funds. The company specializes in data encryption and can rank work done with the governments of Turkey and Ukraine as clients to get key information to citizens securely. Here to unpack its work and its next big move is Transcript's CEO and recently named Forbes 30 Under 30, Zain Zaidi. Zain, thanks very much for joining us.
Thank you so much for having me.
Congratulations on the Forbes 30 Under 30.
Yes, thank you. It was a pleasant surprise.
What put you there? What do you think it is that was the key thing that got you on that list?
Yeah, so we were recognized for our work in social impact. So while we've been doing great on the enterprise side of things, what we did about 2.5 years ago, three and a half years ago, time flies, is at the start of the Ukraine war, we enabled Ukrainian refugees to get access to their verified medical records. So traditionally, medical records are stored at hospitals. It's very hard to access hospitals in an active war zone. So we enabled on-chain, self-sovereign medical records that we gave access to these refugees, so that when they received treatment in, Europe or wherever country that they were going to, they had access to these credentials. So to date, we've serviced over 100,000 such refugees in Ukraine, as well as in Turkey, and a handful of other countries.
And that's incredible to hear. And how important is that then, social enterprise, to your company?
Extremely important. We've built transcripts with kind of the goal, and it's our ethos, actually, that we want to build a company that does good. Obviously, we are a for-profit business, so for our shareholders, but also have used some of our technology, give it on a pro bono basis to nonprofits and other institutions that could use it for good.
And what's the benefit for you with that?
Yeah, well, the first major benefit is kind of on the personal side, right? Both my parents are immigrants, so it kind of touches us personally. Same with my co-founder. We view the world not necessarily just as Canada only, but as a global society, and we want to help out people globally. But second of all, I think technology as a whole has kind of developed a bad reputation for itself. I've spent a good amount of time of my life in the Silicon Valley. Things like AI, crypto, all these buzzwords. If you ask the average person of them, they don't necessarily have the best opinion of these words. And that's because there's fear. And quite frankly, some of these technologies have been used to disadvantage a good chunk of the population. So we hope we can change the narrative and show that technology can actually be used for good.
And let's talk a little bit about the company itself. What's the focus for you?
Yeah, in the Canadian market, we're primarily enabling Canadians to own their verified employment and income credentials. We want you to be able to own where you work, how much money you make, and ultimately disrupt the model that the credit bureaus have. To date, we've scaled that business quite rapidly, 30x in the last 2.5 years. Now with that seed round funding, we're going to continue that growth here in Canada, as well as the United States. Actually, I was just recently informed that we are the fourth or fifth largest provider of employment and income data, right behind the 3 large credit bureaus. So we're pretty excited to be continuing to double down on that mission and enable people to own their own verified employment history.
And what are you doing different from them that you think you can move past them?
Yeah, so the credit bureaus they serve as middle parties. Banks, landlords, employers rely on these credit bureaus to verify and validate our own information, whether that be your credit score, where you've worked, your income history, et cetera. What we're doing is we're giving consumers the ability to actually own their verified record. So we integrate with truth oracles, like we like to call them, that can be like HRS databases, so the human resource information systems at large enterprises, and they can then, using that information, they can prove that they've worked at these enterprises. They can then take that verified record and share that directly with a third party, like a lender, a landlord, a future employer, directly, not having to rely on the credit bureaus. Doing it this way is a lot more compliant with both Canadian and U.S. law, but also, quite frankly, a lot more efficient because you don't have to have a middle party going and fishing these records. And also, from a data privacy and data security perspective, the only person who has access to your credentials is you and the person that you decide to share it with. So we think it's just, all in all, a much more efficient system.
And what are you doing to guarantee? How are you guaranteeing that security and that safety?
All our credentials are end-to-end encrypted. That's something that, quite frankly, the large 3 credit bureaus don't even pretend to offer. In 2017, Equifax was responsible for the largest hack in North America. 180 million odd records were exposed in that hack. So only person who can access your credentials is you and any person you share it with. We use encryption keys. The private keys only held by the user itself.
And can you access it at all? Can your company access it at all, or no?
No.
Once it's locked away, it's locked away. What's it like, just quickly, what's it like being in Toronto, being in Canada as a tech firm and trying to grow this and trying to develop it at your age as well?
Yeah, well, interesting fact, we were originally based in the Silicon Valley. We had our primary headquarters there, but we've begun the process of opening up a second headquarters and, quite frankly, moving our primary headquarters from the Silicon Valley over to Toronto. And we think Toronto has all the right recipes for a growing tech firm like ourselves. It has great universities like the University of Waterloo, University of Toronto, that have produced amazing engineering talent. It has a growing domestic market and growing domestic demand for new technologies, as well as favorable business laws. The Canadian government's done a good job at least not heavily regulating spaces like ours. So that builds innovation and for us to actually build. So we're pretty bullish actually in the Canadian market, but specifically the Torontonian market.
Okay, we'll wrap it up there, Zain. But thank you very much for joining us, and again, congratulations.
Thank you for having me.
That was Zain Zaidi. Still ahead, today's market drivers and more with Bloomberg's Divya Balji. As well, our phone lines are open. Peter Hodson is taking your questions on North American small and mid-cap stocks. Call us at 1-855-326-6266. You can email us, first call at bellmedia.ca. All right, for a look now at some of the early market movers, we are joined by Bloomberg's Divya Balji. She is the managing editor for breaking news in the Americas. My voice is breaking, Divya. Thanks very much for joining us. First up, Warner Brothers. I think we're going to be writing a movie about this soon, aren't we?
I was actually thinking that. I mean, this whole Paramount situation, Paramount has just been involved in all kinds of situations in the last year or two, and it seems to be continuing. And about 30 minutes ago, I think I would have only been talking about Netflix and how they've announced their financing for the deal that they originally put forward for Warner Brothers. And that has quickly changed because not only have we heard about how Netflix is going to finance the deal, which is obviously through a lot of debt, and that is great, and it seems to be keeping investors at bay. But now we've also heard that Larry Ellison is coming in and personally backing a good portion of its offer for Warner Brothers at this point. About $40 billion worth is what Ellison is planning on backing at this point. Now, again, if we hadn't heard from Paramount, if we hadn't heard from Ellison, at this point I would have said, okay, we know how Netflix is structuring this deal, how they're going to finance the deal. That puts Netflix at a much stronger footing in comparison to Paramount. Netflix debt is also something where if you were to look at it from a ratings agency perspective, it is investment grade at this point. But then you now have Ellison coming in and saying, that he is going to back it by $40 billion. That is huge. That still tells investors, okay, this deal could possibly go ahead based on the fact that Ellison is coming in and doing this in and of itself. I think at this point, we have seen Warner Brothers shares climb in pre-market trading after the latest from Paramount. And I think we're still just going to keep seeing a little bit more of this. I mean, the market has already been saying, brace yourselves for a lot of fighting and going back and forth between these companies. And this is what we're seeing today.
Man, oh man, Ellison really wants this, doesn't he?
I mean, that's the interesting part in this, right? I mean, who knows what really is the reason behind all of this? But, with a lot of these, companies and billionaires, essentially, when they want something, they really try to go out there and try to get it. It will really be interesting to see who will end up with this deal in the future. I will say that I did get an email from Netflix when the deal was originally announced, essentially making it sound like the deal was done, and yet we're still seeing a lot of this go back and forth right now, and I think there's still a lot more to be seen at this point as to where this truly ends up in a couple of days, in a couple of weeks, maybe even months. Yeah.
Okay, well, let's get one more in. Uber and Lyft, they're teaming up with Baidu to trial driverless driverless taxis in the UK.
Yeah, I mean, if you think about, robo-taxis, the ones I tend to hear a lot about is Waymo. Obviously, Tesla is trying to get involved too. Zoox, I think that's from Amazon. But the fact that Baidu is also obviously getting a lot more involved, it's not extremely surprising. Baidu has already been trying this out in the Middle East. We've seen them in Abu Dhabi doing this. We've also seen them in other parts of Europe as well. But the fact that Uber and Lyft are now partnering with Baidu to work on these or to get testing out on these in London, a very populated city, is quite telling. When it comes to Uber, they're expecting to get this going in terms of testing it out in the first half of 2026 and then take it commercial after that. Lyft is still in the regulatory process for this. I don't know if you've actually sat in one of these cars and taken it around. The nerd in me actually got to do it a few months ago in Vegas, and I totally loved it. I thought it was very, very cool. You know, it's quite a different experience. That being said, not having someone actually driving the car can still be quite nerve-wracking. So I'm sure this regulatory process that Lyft has to go through is something that a lot of people are going to be paying attention to as well.
I agree with you. I don't even like handing power over to anybody to drive, let alone nobody to drive. Divya, thank you as always for that. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the early notable analyst calls and recommendations, including an upgrade for Cummins, the engine manufacturer. Well, let's take a look at some of the notable analyst calls and recommendations. Raymond James came out with two new ratings this morning. First up, Cummins. The engine manufacturer was raised to outperform with a new price target of US $585. Raymond James citing growth potential for the company. And on the flip side, the firm cut its rating for American Packaging. Sealed air to market perform to strong buy, from strong buy to market perform. The downgrade follows the previously announced take-private offer. And finally, Jefferies has initiated coverage of a space-based intelligence company, Black Sky Technology, with a buy rating and a price target set at US 23. Well, amid the rush to finish up holiday shopping, new reports find many Canadians are choosing to spend less this year. Families are looking for savings just about everywhere, with one big exception. CTV's Colton Prale has more.
It's the season of giving.
Merry Christmas!
But some Canadians find themselves giving
less. And you can do it if you're good at knowing what the prices are.
A new survey from TD Bank found more than a third of Canadians are cutting back on holiday spending, up from last year.
Me and my partner decided actually not to exchange gifts between the two of us this year. It's so expensive.
It's not just presents under the tree that are getting trimmed. According to TD, of those planning to save this holiday season, nearly half are cutting back on social spending.
Especially with groceries are way more expensive, so it makes like hosting and having parties a lot harder.
But even as holiday budgets decrease, 46% of people are actually spending more money on Canadian products, according to Business Development Canada. At this Ottawa artisan shop, that's leading to a boom in new customers.
When folks can check all the boxes and they're not draining their bank account or taking out loans just to support the Canadian economy, then it's a win-win.
Still, according to TD, over 3/4 of Canadians admit they're vulnerable to overspending on the holidays, feeling the pressure to create memories or spend extra to give meaningful gifts.
It is something we're willing to pay for because we really want to support Canadian producers and makers of products.
According to a report from Business Development Canada, if families spent an additional $100 of their expected holiday shopping on Canadian products like this one, the benefit to the national economy could be as much as $2 billion.
And that was CTV's Colton Prale. A term called Thriftmas is turning out to be popular this year. Instead of buying fully priced items, some shoppers are opting for second-hand. CTV's Sarah Plowman has more.
The aisles map the route. Shelves hold the treasure. Thrift stores are full of finds, and Paige Morgan is out to discover them for Christmas.
It's better for the environment. And then my pocket. I have a very small pocket.
We have a lot of...
As higher costs drag bank accounts down, thrifters have more company. Home care worker Kathy DeLong helps seniors, and today is helping those who are shut in shop for Christmas.
Everybody's on a fixed income, and especially seniors. They got to watch their money very carefully.
Thrift stores have noticed a lot of traffic this season.
We sold a lot of toys. A lot of families that are coming in that can't seem to afford the full costs of a lot of the stuff, but still want to give the kids things.
Same down the road, where shoppers scoop up furniture or decorations.
It's those, a lot of times it's those unique gift ideas as, oh, I'm looking for something really interesting for a family member. And
this Fredericton consignment store has also noticed a bump in sales.
I think people have caught on that you can stretch your budget further and not sacrifice quality or the styles you want.
Beyond the discount, store owners highlight other perks.
You're not having to, get into the commercialism and you're repurposing valuable things, people that have loved in the past, and they're getting passed on so someone else can love them just as much.
Another reason for this mom to buy her kids' toys here.
Some toys he gets that are for gifts, I'll find them in the thrift store, like for $5, and it's just better to get them here instead of them going to the landfill.
Swapping Christmas for Thriftmas. One find at a time. Sarah Plowman, CTV News, Fredericton.
When we come back, Peter Hodson takes your questions on North American small and mid-cap stocks on First Call. All right, time now for First Call, and actually it's our first email, and this one is from Glenn. It says, "Hi Peter, can I please have your opinion on TELUS? Seems like a lot of tax loss selling. Will they keep the dividend?" Peter.
Sure. So TELUS dividend yield right now is 9.6% for a nice stable telecommunications company. Everyone's concerned about the dividend. They're worried about it going to be cut. They did say they're not going to increase their dividend. They're going to hold back on that over the next couple of years. But really, this is a company that needs to kind of get back to common sense. So they said they were going to focus on debt repayment and make sure their dividend's okay for a period of time. And then the next day or next week, they announced a $500 million share buyback. So they really have to kind of calm investors down. I think the dividend's okay for a period of time, but we saw BCE cut, and at a 9.6 yield, if it gets to 10%, I think the company will start looking towards a cut. They don't have to, but sometimes the market forces a company to do it, and they might not buy the stock until they cut the dividend anyway. So the stock may just flounder until there's some decisive action taken on the dividend there.
Okay, so let's move on and get an email from Brian. How does Tamarack Valley, TVE, look over the next 12 months? Crystal ball, please, Peter.
Sure. I mean, we were talking about small and mid-cap stocks. This is a company that's doing a lot of things right. So they did increase their dividend by 5% in November. Their decline rate on their assets is quite low. They've bought back 40 million shares over the past 18 months. The valuation's okay. And like anything in the oil and gas sector, it's going to be commodity-based. But it's a very well-managed company. And just very recently, they put in a shareholders' rights plan, which sometimes implies that they're worried about getting taken over. They said that there was not a response to any particular bid, but generally these shareholder rights plans are put in place when companies are worried. They're never actually used, but it's sort of a statement that said, hey, we're undervalued, and maybe someone's going to be circling the wagons looking at us, like the MEG takeover energy situation that we saw a couple of months ago.
And they're riding, I imagine they're riding a bit of the AI with this as well, that everybody needs energy. Okay, Lender's up next and says, what's your outlook for Allied Property REIT for 2026?
Sure. If Tamarack is an example of how to run a company, Allied is the opposite, of course. So they actually cut their distribution by 60% in early December. It wasn't really their fault. At one point, they were 100% tied to the office market, the office real estate market. And of course, when the pandemic came along, no one needed an office anymore. And it's really started to hurt the company. It's hurt it from a valuation point of view, but really from a sentiment point of view. If I tried to sell you an office REIT right now, you'd say, well, no one really goes to the office anymore, so why would I want to buy that? So they're struggling. They're trying to manage the situation. They have sold some assets. Their debt situation's a little bit better than it was. And of course, a giant distribution cut is going to help their free cash flow going forward. But they need to diversify. We need to get these office workers back in the office for Allied to really get back on track. So the stock's way down on the past year. There's probably still a little bit of tax selling left there. And I just think it's one to skip until things get better.
But we have started to see people going back to the office, and a lot of businesses are now going 4 days at least, if not 5 for many of them too. So it's turning around, but you still think it's too early?
I think it's still early for the stock. I mean, you have to get the dividend refugees who like that distribution, and we have to get them out of there. You've got to get the stock to turn over back to a group of investors that are willing to put in the long term to see this recovery. And you have to get the situation of the debt under control. I mean, a lot of these office companies and real estate companies have a lot of debt. That in itself is not bad, But right now, the real estate market is, even with a return to the office, it's not exactly gangbusters in the real estate land right now. Interest rates going lower will help. It is, of course, tied to the economy as well. So, we may be at a bottom, but that doesn't really mean it's going to go up in terms of stock valuation either.
Okay, we're going to sneak one more in. We're almost out of time, but you got a little bit here. From David, I bought Celestica at 68, sold at 100, bought again at 123. Now it's about 425. Is there any further room to run on this, or is it time to take all my profits and run, exclamation point?
It's just such a solid company. One of the things it has is scarcity value. There's very few AI-related companies in Canada right now, and Celestica is a $46 billion company that's completely tied to AI. They've got fast-growing customers. As we mentioned earlier, all their customers are increasing their capital spending. The valuation's a bit up there at 46 times earnings, but don't underestimate the value of scarcity. You've got a situation where U.S. investors have adopted this company as the next greatest thing. Margins have improved. They are now tied very, very closely to their customers instead of just being a cheapo and low-margin contract manufacturer.
All right.
And I think there's room to run.
Okay, we're going to have to wrap it up there. Peter, all the best for the holidays. Thank you, as always, for joining us. And hope you get some downtime. Thank you again. Peter Hodson is the CIO of I2I Capital Management. That's it for us here on The Street. Again, thanks to Peter for joining. And he's up next with The Open. The markets will open a little more than 30 minutes from now. Have a great day.